From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 15th. You're listening to the HPS Macrocast. I'm Matt McDonald in for Tony Fratto this week. I'm joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. Let's talk about the week that was here. And I think that there was some good, really to me, the week was framed by Jay Powell's remarks. It felt like a kind of, it's interesting the way that he has bookended the framing of the pandemic crisis from a economic policy perspective. I mean, he was really out of the gate early with pretty overwhelming force from the Fed. And it felt like his comments this week provided another kind of landing point to assert the proper place and role of debate around the economic policy response to this week. Brendan, do you want to touch on kind of the comments themselves and what he went through and outlined this week?
Well, so after it came, he spoke, and John and I listened to it, and we were like, that was exactly kind of what we expected. He basically reiterated everything that he'd been talking about, and Powell, I think, clearly understands that this isn't a recession. This is a crisis, and a crisis response is different than a recession response. And because it's a virus, it's very difficult to predict what the future is going to be. So he's kind of saying we have to go big, and we have. But the market, I think, took it negatively because he kept reiterating a cautious, concerned tone, but then didn't do anything new. But he's done $2 trillion.
Right.
Things. And actually, a lot of them haven't. The Main Street lending program hasn't even gotten going yet.
Right.
Where I think a lot of people that are criticizing his response, saying he's doing too big, are looking at this through the normal recession lens, and that now our deficits are going to be too big and all that. But if we don't go big now to fill a monstrous hole that was artificially created, we don't even give ourselves a chance to grow and then tax to refill those coffers. We're just going to be in a hole, and we argue over what kind of recovery is going to be, a V, a W, a U. If we don't do something now, we're not going to have much of a recovery.
Yeah, it does have this question of I feel like most of the mental models around policy response to quote unquote recessions are in some measure about calibration.
Yep.
Of okay, what do we have to do to get it growing again? Understanding the long-term constraints of we don't want to either overheat or we don't want to miss the mark or whatever. In a crisis where it's just the bottom falls out, it does have this quality of lost growth, as you say, lost growth. We can always, if we give out too much money, the government can always tax it later.
Really important point.
Yeah. But if you lose the growth, there is nothing to tax on the back end. That has a self-reinforcing quality to it.
100%.
Yeah, and Powell mentioned really the market participants were looking for him to be casting a glance ahead, giving some guidance as to what the Fed might do. He said in his statement following the late April FOMC decision that, in his opinion, the Fed was likely to have to do more, but he hasn't specified that. The only thing he specified, he went out of his way to say that he wasn't going to do, or they weren't considering currently negative interest rate policy. Right. They didn't categorically.
Really the biggest story from his speech.
Yeah, he didn't categorically say we're never, ever, ever going to do it. That's central bankers obviously want to limit themselves in right. that kind of way. Yeah. But about as clear as possible a statement that this is not on the policy agenda currently and is way down their priority list.
And the reason he had to do that is because Fed fund futures are starting to price in the future negative rates. But the reason that they are pricing it in is a bit of a self-fulfilling prophecy, because once the notion got out there, a lot of the big banks started to hedge in the Fed funds futures market against that happening. But it's pretty illiquid market. And once one or two big guys do that, then the Fed fund futures start pricing in negative rates. So it's not necessarily that everyone thinks it's going to happen, but you're trying
just
to
a market structure function
happening, which then becomes higher probability of maybe it happening.
Yeah.
Well, that's the market's self-fulfilling prophecy aspect. If people start looking at Fed fund futures negative, then they say somebody knows something that I don't know. And it was the Fed came out all this week, and it wasn't just Jay Powell. It was just an array of other FOMC members coming out and saying that this was not a favored policy by any stretch of the imagination.
And it's not that it couldn't happen, but the Fed would do probably 5 things before that. And one of those things would be QE infinity. You know, they're going to do a lot before they come to the level of trying to go negative rates.
The other thing he addressed was the need for fiscal policy in this context.
Yes.
Which, you know, anytime he's talking about the importance of Congress taking action, I feel like there's a collective groan from the markets of like, oh God, we got to rely on those guys.
Yeah. And also going back to self-fulfilling prophecies, Congress pays attention to the market, and the markets are at recent highs. And I think there's a sense here on the Hill that things aren't that bad.
Yeah.
And what it really is true. I mean, from anyone that's and you've been there as well, Matt. Anybody that's been in a policy context, for better or for worse, the S&P 500, the Dow is, or whatever the equity one that you focus on, equity index you focus on, it really is a disciplinary function that it applies. And when it is on the screens every day and the market is falling, you know, policymakers tend to scurry around to do something to try to prevent it. The other markets don't have that same kind of immediacy that the stock market, that headline grabbing 401k smashing, daily opinion poll almost is the way it can feel.
Well, Matt, you were at the White House when the TARP bill failed.
No, I was flying around with Senator McCain on the campaign trail.
Oh, okay. Yeah. So,
which was equally fraught.
Yes, exactly.
You guys are exactly right in that, like, policymakers and politicians look to the market for calibration. The trick is when you enter into this circle of the market is pricing in action by Congress, and Congress is looking to the market to figure out whether they need to take action. When you get into that trap, there's a miscommunication between the two. And so, I would say that politicians in Congress are not attuned to kind of what is baked into market assumptions the way that, say, the Federal Reserve is. And so it's easier for miscommunications to happen on that score where, like, the market may be expecting congressional action and Congress is like, well, the market seems fine, we don't need to do anything. And then everything goes sideways, right? I mean, I think that was a little bit of the financial crisis.
Which is literally why John and I started Markets Policy Partners.
Yeah.
I think there was a bit of miscommunication around or sort of misread around Chair Powell's remarks. A lot of the market commentary thereafter was markets sink on downbeat commentary by Jay Powell. That's very, that fair enough. There are a lot of, it's hard to disprove really. But our take was a little more nuanced. It really was about Chairman Powell didn't say anything really different. And in terms of the outlook, he's been very cautious on the outlook. What really changed was the context. We had Dr. Fauci coming out the day before, and he was extremely cautious as well. And so it was kind of a 1-2 punch. But also it was, the last time Chair Powell had a big speech was 2 weeks ago. We've had 2 weeks for the market to kind of get over, to digest some of the real difficulties of reopening. During that 2 weeks, we've had a lot of stocks, particularly the tech companies, rally up a lot and stall at important resistance. The 200-day moving average, the S&P 500 banged its head into that. We've had a really long, bull market. I mean, if this is a bear market rally, we've had a pretty big one.
Yeah.
And so really it was a very contextual difference from what when he was speaking at the end of April.
Yeah.
And we've made the point many times throughout this whole 2-3 months that the market isn't the economy. And this is never more apparent than right now. In a normal recession, kind of most people don't do good. Like Campbell's soup does okay because, you know, you buy more soup because you're not going out to restaurants. This one has created monstrous winners and monstrous losers. So looking at the index as a whole doesn't give you a sense of what's going on the ground. So it's very dangerous for policymakers and elected officials to say, you know, the Dow Jones is doing okay. We don't need to bail out the states.
So there has been this week congressional action is too strong a word, but there's been congressional activity.
Yes.
The House Democrats have been looking at the HEROES Act. It's not getting a great reception on the Republican Senate side. It feels like it's at least a, you know, I think Speaker Pelosi is laying down a marker of kind of what the shape of a next support bill could look like. How are the markets looking at that activity in Congress this week?
That may have also been one of the contextual aspects of Jay Powell's, Chairman Powell's speech on a day when the Treasury Secretary has come out either that very day or pretty recently and said, you know, we're on pause here on this next stimulus. Obviously, Senate Majority Leader McConnell saying very similar things. President Trump characterizing the Democrats' proposal as dead on arrival. And, you know, with that as the backdrop, with Chair Powell saying, you know, what we really need is fiscal policy, it's easy to see why investors thought, gee, you know, here we go again. But we've seen this movie before. The initial offer is always, absolutely trashed by the Republicans or the other side. And the White House, with Secretary Mnuchin being the spearhead deal maker up on Capitol Hill, the White House has revealed itself to be pretty open to a variety of different formulations. And if you're in an election year and the economy is in the shape it's in, it's easy to understand why they've had this degree of flexibility. And, you know, lo and behold, yesterday, in the middle of the day, the Washington Post comes out with a story about, a bevy of White House officials telling them that opposition to bailing out the states that's featured in the House Democrats version of this next bill, the HEROES Act, that opposition to that in the White House is softening. Yeah. President Trump comes out and says, Americans might just get another stimulus check with his name on it.
There was this sense that bailing out the states is a red state, blue state issue. And in the past, you know, Illinois is a basket case, and New Jersey, and, you know, whatever, Texas and Florida are okay. But states don't have huge rainy day coffers. You balance your budget, and then you go to the next year. Everybody in April had somewhere between a 40 to 60% drop in revenue. Yeah. Florida is the hardest hit. They're entirely dependent. They don't have an income tax. They're entirely dependent on tourism, and it's none. So I think the White House got enough calls from governors saying, we're going to have massive layoffs in a month or two if you guys don't help us out.
Yeah, I would say that, you know, if conservatives are concerned about the moral hazard problem of Illinois and New Jersey, I feel like they should count on the fact that those states will still have problems even if after a bailout. Like that, I have confidence in their ability to make a train wreck of their budgets. It won't be a problem.
Right. Yeah.
Yeah. You know, let's take a break there. When we come back, I've got another game in store for us. This is the HPS Macrocast.
HPS affiliate Flag Media Analytics is a next-generation media monitoring firm designed to shorten the decision-making process for public affairs professionals. Our expert analysts will work with your team to ensure only the most relevant content reaches their inbox and provide custom metric solutions for the evolving news cycle. To learn more about how Flag can get you ahead of the cycle, visit flagmediaanalytics.com.
Okay, we're back on the Macrocast. This is Matt McDonald. I'm with John Fagan and Brendan Walsh. So I'm subbing in for Tony this week. I feel like I get to do the cat in the hat bit when he's away. I can come up with all sorts of fun games to play. So the game this week is Hail Mary predictions. So what I want to go through is, what is your, of the least likely events, what is your most likely event of the least likely events? Okay, so think about if you were to take the opposite side on one aspect of conventional wisdom, however defined, what would it be, and why do you think about it that way?
All right, I'll take the first cut. It's kind of referencing something that Brendan said before and that we've talked about before, but my least likely, most likely event is the U.S. equity markets go bonkers to the upside. And this isn't a bear market rally. We go back to new highs and then beyond. That is not our base case. Our base case is, and as we said in a previous game that we played with you, Matt, on an earlier edition, our bottom or not bottom, our base case is the S&P 500 is not bottomed. We're of the view that this is a relatively longer tail, and the solvency issues that we have facing us as the economy stays in varying degrees of life support or intensive care.
But you think it's possible that we have actually hit bottom and that it's upside from here? Among
the least likely things, I think that this is the most likely. So one of the things that you can say, and Brendan said this before, is that the tech stocks and healthcare stocks have been really pulling the sleigh here. And so you can have the markets go back up to, to highs. The NASDAQ was positive on the week positive on the year earlier this week. Yeah. And that's because basically investors are given no choice at all. You can't make any money in yields in any sort of fixed income. Your investment universe is basically limited to, the kind of narrow winners, quote unquote, from the pandemic, the big tech stocks, and everybody just piles into them. And the Fed is, this is not just a fundamental issue. It's also, the Fed has done this by design. Chairman Bernanke, when asked on his way out the door of the Fed, how does QE work? He said it works through the portfolio rebalance channel. We take safe assets out of the market and chase people out the risk curve. And so they have to we're forcing them to go into it. And it works through the wealth effect by pushing equities higher. Quantitative easing, that's what it says on the box. It inflates asset prices. And it's certainly possible that, with the massive amount of quantitative easing that the Fed is doing, what are they buying? 35 billion a week? Yeah. Until, from now until they achieve their goals. This is basically QE forever. So it's a huge liquidity injection.
So if your most likely, least likely were true, forecast that forward. What does that mean in 3, 4, 5 years?
Well, I think honestly, even before that, I think it ends up kind of being a problem, because our view is that the economy is not going to respond in any way, shape, or form as smartly on the upside here. And if you get a stock market that is so totally divorced from economic fundamentals, it begins to raise a lot of questions about the policy supporting the stock market, socialism for the rich, and that sort of stuff. Puts a bullseye on the companies that are leading the charge. You saw in their earnings call, Amazon Jeff Bezos come out and say, shareholders, sit down. We're not looking out for you. We're looking out for our workers. And I think really part of that is because, they're now the nails that are sticking up. Tesla, Musk came out and said, my stock price is too high. He said that before, but this could be a real problem if that happens, I think.
The nails that are sticking up is, that's a theme for a podcast. We need to file that one away. Brendan, what's your most likely, least likely?
Well, first, this is predicting, but I feel like no one's talking about the fact that in the election, we have 2 70-year-old plus men that are going to travel around the country in a pandemic. That worries me. But I suppose my most likely, least likely is a Nixon to China event, where Trump, just for some reason, totally reverses course of playing hardball and hops on a plane and meets with Xi, and they hammer something out.
Hope springs eternal. I thought you were going to go in the direction that the 2 heads of the ticket now will not be the 2 heads of the ticket in November.
But I don't want to be on record of predicting death of anybody.
That's like that is a political junkie fever dream.
Right, exactly.
How about yours, Matt? What's your
my most likely, least likely is actually that the public health community generally figures out an effective remediation plan by the end of the summer, and that we're not going to see tourism back bounce to where it was, but that the economy will functionally reopen, that there'll be some version of masks, that there will be some version of the testing regime and kind of entering protocols and that sort of stuff, that by the time we're in kind of late third quarter, is that things aren't going to be back to normal, but like people aren't going to be cowering in their homes. I mean, my anchor point on some of this stuff is that it's very difficult in the moment to appreciate that it will end at some point. And the fact that the response and the guidance has been so kind of all over the map to date, I think people's mental models shifted very quickly from like, oh, this is a 2-week, 4-week exercise to it's going to be like this until there's a vaccine early next year. And people, I think that's part of the reason people are kind of losing their minds a little bit. But that there will probably be some sort of remediation strategy of like, okay, this is kind of generally how it happens. And I don't know, it's interesting watching the kind of public health natural experiment going on with the different states and their different reactions and this sort of thing. I kind of worry over the medium term. I forget if it was Talib who was talking about the death of expertise and that sort of thing, is that, man, this feels like another moment where all the people who were supposed to know what to do didn't know what to do. And I kind of exclude the politicians. I don't think people expect the politicians to know what to do, but like the public health community of like, the no masks to masks to like, where's the test, and the mess ups around that is like all those systems. I think there's going to be some accountability on the back end. And I think that it's an interesting exercise to watch the public communications on this, because it hasn't been super tight. But I think that eventually they will get it right, and we'll kind of know the basics of like, okay, we can keep it below this level. I mean, even within what to do, there's different countries around the world that are implementing different plans, and we're seeing kind of impacts in real time. I just think that by the time we get to, say, Labor Day, is that there will be some understood remediation practices in place that will be helpful.
We did a call with clients in Hong Kong last night, and Hong Kong restaurants are open. The only limitation is that it has to be 1.5 meters apart for tables and a limit of 8 people. And the reservations are sold out. But they have a proper 3-4 month shutdown, and they do testing and tracing. And that's what you need to kind of go back to normalcy. And I think here we think that we can just go back to normalcy. But what worries me about the reopening of the country, I don't really care about what the governor says, whether you can or can't do things. Things have been so disjointed that I think people don't trust it. And when you're like in Texas and Georgia, we're able to see, kind of through real-time data, how many people are going back to restaurants.
Yep.
And very few people are going back, and not enough for to make it profitable for restaurants to reopen. So I don't really care what the governor says. I care what the people's reaction.
I do need to stipulate this is in fact my most likely, least likely. Is that if you were to take past performance as an indicator of future performance, we will continue muddling through the end of the year.
Yes.
So
we also have, Brendan and I have 2 honorable mention. One being Eurobonds. They're obviously not there yet. It didn't go into the big pan-European budget, which features a lot of stimulus and support and pandemic relief spending. They DQ'd it, but it was on the table, and we could certainly, if this thing really drags on, that is it's possible, and it certainly would never be possible. It really does take something like this.
Either the EU is going to fall apart, or they're going to develop a new financial instrument.
Fiscal federalism for the EU, the transfer union. And our second honorable mention, and we sound like at the risk of being a laughing stock, infrastructure is not impossible in future stimulus bills. How they do it is, I think that clearly we've had a lot of discussion about this, but funding a federal infrastructure bank, which is it would be the Trump legacy. He funds the
I'm digging on
Donald
that
J. Trump Federal Infrastructure Bank that is funded by the Congress and then levered up by the Fed, and then they work with the states. And
John,
there you go.
I'm with you. I feel like that could be the least likely, most likely. It's like I think that there's a world in which that comes around, if for no other reason than the fact that like there's aspects. I mean, we're doing work in the travel space, and like one of the pieces that we've been talking about is the fact that travel infrastructure is now also health infrastructure. Like you can't get onto airplanes and move through airports and that sort of stuff without a different set of safety procedures around that sort of thing. And like whether, all the kind of like, I feel like the infrastructure conversations has been, hey, we need to renew this and it's cheap right now and that sort of thing. Some of these things are actually things that need to get done in a different way than they have in the past.
But
that's a really good point.
Most likely, least likely, this is for the bettors. So I'm basically guaranteeing, because of the sports seasoning, the playoffs are going to be goofy and we're going to reopening, that we're going to have a Boston sweep of all 4 titles this year.
I love that. I'm trying to think. I mean, the Bruins were in first place.
Could have done it
at the end of the season. Yeah, it's
the short end playoff schedule. The Celtics can easily get it done.
Yeah,
Belichick, because you're not going to be able to practice. Just Belichick coaching is going to win them a title.
Yeah. Why didn't you lead with that? That's amazing.
Yeah, the Red Sox are week 1.
I actually want to come back, Brendan, to your actual original, most likely, least likely on China, because we have seen some China action this week. How should people be reading into the activities there?
So, it's a little bit confusing. So earlier in the week, the Commerce Department kind of did a 180 on Huawei and said that they can be involved in the 5G infrastructure. And then we've now seen them banned from other things. So we're not exactly sure what's going on there. I think that's more of a 5G issue. We basically can't have 5G unless Huawei is involved. But taking that specific 5G out of the equation, the relations are not good, and they're only going to get worse. I suppose the Trump administration has always been hard on China, and that's only going to get harder. I don't think we're going to see anything huge in terms of tariffs that are going to hurt the market or the economy at this point. But if Trump is elected, I definitely think that's on the table. We saw them mandate that so it's the government retirement fund, it's about $400 billion. They're not allowed to invest in certain Chinese companies. So I think you'll see continuations of things like that. One thing that I think the market is kind of missing, the Trump campaign is branding Biden as a dove on China.
Yeah.
And that if he gets in, he's going to make friends and bend over. People in America are pretty mad at China. There's no scenario where you win on a pro-China, platform. Yeah. So I think Biden's going to be just as hard as Trump. He'll do it in different means. He'll do it through normal diplomatic channels, not Twitter. But this is a relationship problem that we're going to have for the foreseeable future, no matter who is in.
It does feel like that's a dynamic that's kind of being driven by the political process, and so whatever the policy dynamics, it's just going to be that we're going to see more of that over the duration, at least until November, if not beyond.
Yeah, and it's not just the federal. There was a report earlier this week that the White House was going to issue an executive order to block the government retirement savings plan, which is called the TSP, the Thrift Savings Program Plan. That it was going to be done by executive order. As of now, that it appears that just political pressure has prevailed upon them to pause the reallocation that would have put some of that government money in Chinese stocks, and so this is probably an indefinite pause. But there are also reports that pressure is, it's there. There's no direct order, but it's pressure on Governor Newsom in California to do something similar with his pension plans, to divest Now that's different. And for the government, for the TSP, for the federal government savings plan, this is about stopping future investment, which would go take U.S. government retirement money and put it in Chinese stock. That's easier than divestment. And so that's an issue. BlackRock has gotten pressed on it as well for the kind of pensions that they manage. It's an issue that it's not new. Senator Rubio had a bill, a bipartisan bill last year. We told our clients at the time, this is coming soon, and this is going to be step by step, and it's going to be first federal and then state pensions. It doesn't happen overnight, but it's a process.
All right, let's leave it there. This is the HPS Macrocast. We will be back with our week ahead.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we are back. This is the HPS Macrocast. Brendan, what do we have for the week ahead?
So on Wednesday, we get the FOMC minutes from the meeting in April. Though since Chairman Powell, spoke this week, I think there'll be a little less market moving. He's kind of already told us where they're going. We also get a number of housing data points in the U.S., the NAHB Housing Market Index, and also housing permits and housing starts. And it's kind of amazing. Right when this started, the housing market kind of imploded, but it's really been bouncing back strong, which is, knock on wood, a good sign for the future. We also, the People's Bank of China will vote on their loan prime rate. So a year ago, they created this. It's kind of like the Fed funds future. It's the rate which all other loans are based off of. And they've cut it now at the last few meetings. It's at 3.85 where it started, up at 4.65 when they initiated it, and they're expecting further cuts there. And then globally, we get a host of manufacturing and services PMIs from all the major economies. So those again will be really important. And most interesting, so on the 20th, the BLS puts out obviously the big employment report, which everyone pays attention to. But a week or two later, they also do it at the state level. They're slightly different, but it kind of adds up to the same. But it gives us insight to what's going on at the state. Usually people don't pay a huge amount of attention to it. But I would argue that now this data point is probably more important than the national numbers.
Yeah,
especially
I'm looking.
when we were talking about with the the state and local fiscal situation.
Yeah, I'm looking at that one too. It's interesting. I do think that's when you're talking about kind of the smaller numbers, is that the difference from month to month typically doesn't add up to much for people to really read into, except when you have a situation like this where you have all sorts of states with different levels of dealing with the virus. You have different policies in terms of whether they're open or closed. You have all sorts of different impacts. One of the things that we talked a lot about with the regular jobs report is the different impacts of industry. When you think about the state level, I mean, you mentioned it with Florida, but different states have different exposures to different types of industries that have been impacted by this. So like, California with a lot of agriculture, a lot of technology, and some of those pieces that will help hold up other pieces that haven't performed. Whereas you get states like Nevada or Florida that have kind of tourism heavy dimensions to them. That's a huge problem. You get some of the states that have that are involved in oil or shale. I mean, and then you have New York, which has been the epicenter in the United States and has been functionally shut down. It's just going to be a very interesting report to look through for the geographical impact of what we've seen over the past couple months.
No, it's a great point. And going back, that this isn't a red state, blue state thing. Everybody's being affected, and what you had done in the past with your fiscal house doesn't really matter. Hawaii is basically entirely shut down. Everybody's out of a job. And similar with Florida. If you're tourism, there's no tourism.
All right, guys, that is it for the HPS Macrocast. Thank you to John. Thank you to Brendan. My name is Matt McDonald. We will see you next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter at Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.